Okay, my name is Bobby Vaught. This is lesson number 10. Everything you need to know to understand investing. We have a lot more to come. Don't forget to hit the subscribe button. I'll put a link to lesson number 1 in the description below. So if you're new to this channel, lesson number 1 is easy to find. Go back to the beginning and just go through every lesson. By the time we get done, we still have a lot more to come. You're going to be an investing knowledge guru. You're going to know more than 99.999% of the people out there. So, link to lesson 1 in the description below. In addition to that, every lesson has a link to the next lesson, so they're all easy to find. Okay, so today we're going to talk about options trading, currency trading, and commodities. Okay. And I'm put all three of them in one lesson because they all have something in common. And I'm going to try to explain what that is. Way back in the day, I made my first investment in 1987, so that was 37 years ago. Way back in the day, somewhere around that time, mid and late 1980s, at that time, I wanted to understand every single thing I could about finance. Investing specifically. I eventually ended up getting a business finance degree from Texas A&M Corpus Christi, but in addition to that, I would just put myself through the equivalent of a whole college course on everything. I wanted to know everything about the stock market, bonds, currency trading, options trading, and commodities. I would just study all of it. I wanted to know everything I possibly could about all of that. And cryptocurrency didn't exist at the time. As we know, that didn't come until later. So I just wanted to, immerse myself in this stuff. So I did. 1, because money was involved, and 2, because I just found it interesting. So I would just go find material on my own, and I didn't read the material, I would study it. I mean, I would take a book like this one, for example. I still have all the books on the bookshelf in there. I would take a book like this one, for example, Currency Trading or Currency Strategy. The practitioner, this one was by somebody named Callum Henderson, The Practitioner's Guide to Currency Investing, Hedging, and Forecasting. Okay, so I would take these books and sometimes I would just late at night sometimes I would go to maybe a coffee shop like a Denny's or a Denny's-like restaurant, for example, and I would take a notebook and a pen or notebook and a pencil, and I would just sit there and study this stuff page by page, taking notes on it. I wanted to know every single thing I could possibly know about all of these things. What I discovered was the more I delved into it, the more I realized that I just wanted to stay in the stock market, and I'm going to try to explain why. You want to be an owner of capital, owner of means of production, and sometimes fixed income. There is a time and a place in a portfolio for fixed income. There's a best time to buy bonds. We covered that in a previous lesson. Okay, so I immerse myself in these things, and in currency trading, let's start with that one. Currencies are always done in pairs, and they have a broker. The primary broker for currency trading is Forex, right? So currency trading is always done in pairs, like, for example, United States dollar against the yen, or the yen against the euro, euro against the dollar, various other currencies involved. What I discovered was, as I delved into these things, I began to realize in those three things, options, currency trading, and commodities, you're just making a wager. That's really all they are. You're making a wager. In sports wagering, they call it the sports book is in business to make money. They're not in business to lose money. In sports wagering, they have a VIG. They call it a VIG. So, and here's how it works. You have, I don't know, maybe a football game, Bears against the Vikings, right? And let's say one team is favored by, I don't know, 4.5 points. This is just an example. I don't really follow football that closely anymore, so I don't know what the point spread would be. But let's just say it's Bears favored by 4.5 points. So the way you read that in sports wagering is Bears minus 4.5, Vikings plus 4.5. So if you bet on the Bears, you have to give up 4.5 points. You bet on the Vikings, you get 4.5 points. They also have odds, what they call the money line bet, where it's just, that's you're just betting on one team or the other to win outright. Okay, so but they still have a vig. And the spread bets, you bet $11 to win 10, or $110 to win 100. Typically, that's how it works. So, for example, for somebody bet $11 on the Bears, somebody bet at minus 4.5, somebody bets $11 on the Vikings plus 4.5 points. And the sports book couldn't care less whether the Bears or the Vikings cover the spread. It makes no difference to them. They don't even have to care that much about football. They don't even watch the game. That makes no difference to them. Maybe the guy at the sports book, he's interested in the sports. Doesn't have to be. It's not a requirement. They're just wagering. They're just brokering wagers. That's all they're doing. So, for example, the Bears cover the spread. In our example, the football game takes place. The Bears win by more than 4.5 points. They win by 5 or more points. Bears covered the spread. So what does the sports book do? Well, they already took the bets. They took somebody's bet of $11 on the, or $110 or $1,100 or whatever it was. They took $11 bet on the Bears and $11 bet on the Vikings, total of $22. They pay back. The Bears covered the spread. In the game, the person who bet on the Bears gets their $11 back plus the $10 if they won. The person who bet on the Vikings just loses their $11. Okay? So, in other words, for every $22 that's bet, the sports book has revenue of $1. 1 divided by 22, it's roughly that would have to be roughly about 4.5%, give or take. 4.55%. Let's call it 4.5%. Okay, so that's the revenue for the sports book. They don't care who covers the spread, except in some very rare circumstances, some strange things that can happen to cause the sports book to lose money, but it's very rare. I'm not going to get into that because it's kind of outside the scope of this video. But the sports book, generally, they don't care who covers the spread. Neither does Forex. They don't care. Somebody is making a wager on the yen improving against the euro. Somebody's making a wager on the euro improving against the yen. The currency broker couldn't care less which direction it goes. They're making money either way. Okay? They're just brokering bets. They're brokering wagers. That's all it is. Commodities trading, same thing. If you ever saw the movie Trading Places, I don't remember exactly when the movie was made. It's roughly 30 years ago, perhaps. For those of you who didn't see the movie, I'll kind of set it up here. So the movie had Jamie Lee Curtis, Dan Aykroyd, Eddie Murphy. So these two men run a big-time commodities broker. There's big-time commodities broker business. And I think they're brothers, as I recall. It's been a long time since I saw the movie. But these two men decide that they're going to try to teach Eddie, I'm going to call him Eddie Murphy. It's a fiction movie, but I'm going to call him Eddie Murphy because I don't remember what the character's name was. So these two men decide they're going to find out if they can teach Eddie Murphy everything there is to know about being a commodities broker in 30 days, something like that. Eddie Murphy in the movie, he plays a very streetwise guy. He's very smart, really smart, but he's streetwise, not so much, Wall Street or commodities brokers, not that, he doesn't have that kind of knowledge, but he's very street smart. So these two brothers, the first day, they're going to teach Eddie Murphy everything to know about being a commodities broker in 30 days, and the first thing they tell him is, somebody thinks price of orange juice is going to go up, somebody thinks the price of orange juice is going to go down. We make money whether it goes up or down. To which Eddie Murphy responds, and you can kind of picture how he would say this with that big smile, right? Eddie Murphy responds, "Oh, I get it. You guys are like bookies." That's right. It's exactly what they are. In currency trading, commodities trading, options trading, they're bookies. That's all the broker is. That is not true when you buy, for example, common stocks. You're not making a wager. The broker does have a difference between the bid and the ask. The bid would be the price at which you sell something. The ask would be the price at which you buy it. And the difference between those two things is their revenue, okay? So they do have revenue when somebody buys common stocks, and certainly there can be a short position on the common stock, and there oftentimes is. A short position basically just means somebody thinks it's going to go down. The price is going to go down, but that's a little bit different than options trading. We'll get back to that in a second. There can be a short position. However, that short position is not required in order for the security to exist. McCormick, you know who they are. They put spices in those little bottles, right? Consumer staples. It's a consumer staples company. When you buy McCormick, you are an owner of capital or an owner of the means of production. You're not making a wager. The short position is not required for the long position to exist. It can exist and oftentimes does, but it's not required. Okay, very important to understand that. You're not making a wager when you buy common stock. You're just becoming an owner of capital, owner of means of production. Okay, why do sports books exist? Why do people go to sports books to make wagers is the question I wanted to ask. Well, there's two reasons. One, the sports book, they lower transaction costs. They match people who want to bet on the Bears versus people who want to bet on the Vikings. If you wanted to bet on the Bears, if you're into that kind of thing, I'm not. If you're into that kind of thing, well, if you wanted to bet on the Bears, you would have to go find somebody who wants to bet on the Vikings and make the bet. Okay, so as a matter of convenience, people go to sports books. That's the reason. They're willing to give up that 4.5% for the convenience. And the second reason people go to sports books to make their wagers, if you just went out there and found somebody who wanted to bet on the Vikings, you could do that, but you may not get paid, quite frankly. You might have to go play collector and go find that guy and say, hey, the Bears, cover the spread. You got to pay me, right? So that's the other reason people go to sports books. They know they're going to get paid. The sports book takes the money up front, and then they keep the money on the loser and pay off the winner and keep the big. That's why people bet. That's why people go to sports books. And when you think about it, a grocery store is a type of broker. Brokers serve a very important function. They lower transaction costs. People who say, well, they don't really, produce anything, or they serve an important function. Grocery stores, when you think about it, are kind of broker. They're matching buyers and sellers. If it weren't for grocery stores, you would have to go to this place to buy tomatoes, that place to buy potatoes, that place to buy some other vegetable. Tomatoes is actually a fruit. A lot of people don't know that. You'd have to go to some other place to buy meats. You'd have cheese, milk, et cetera, et cetera, et cetera. So the grocery store is a type of broker. They lower transaction costs. They serve a very important function. All right. So we've covered currencies and commodities so far. You just when you get involved in that, you're just making a wager. That's all it is. You might as well be trying to figure out whether the Bears or the Vikings are going to cover the spread, quite frankly. Options trading. This is how options trading got started. Way back in the day, I don't remember when from reading this, it was mid-1890s, somewhere around in there. Stock market existed in those days. This is roughly 130 years ago. So some people got the idea they were going to sit around in some room and start placing bets on whether a stock was going to go up or down. Okay? So then they needed they had to put a time frame on it. How do you know when somebody won the bet? Well, had to put a time frame on it, strike date. Then they had to say, well, up by how much? Is it going to go up by this much or only that much? Strike price. So they started making these bets. The brokers, the stockbrokers, saw what was going on and decided, well, let's get in on that. Let's just broker these wagers with people. So they did. That's how options trading got started. Okay? So there's two types of options, and we're just going to give just the basics here on options trading. Two types of options: a call option, a put option. When you buy a call, and we're going to find out why it's called an option in just a second. When you buy a call option, you're saying the price of the underlying security, like for example, XYZ company, let's say it's anything, let's call it XYZ company, it's trading at $100 a share. Just an example. When you buy a call option, you're saying the price of XYZ company is going to go up. Okay? Let's define it. We're going to find out why it's called an option. A call option is a right, but not the obligation. There's why it's called an option. The right, but not the obligation to buy a security, the XYZ Corporation, at a specified price at a specified date. So that's called the strike price and the strike date. Okay? Put option is the opposite. When you buy a put option, you are buying the right to sell. There's the right but not the obligation. There's why it's called an option. The right but not the obligation to sell a security at a specified price at a specified date. Put option. So when you buy a call that's bullish, you're thinking the price is going to go up. When you buy a put option that's bearish, you're thinking it's going to go down. You can also sell an option. In fact, the sell is required for the trade to exist. It's a wager. When you sell a call option, and now it's just the opposite. When you sell a call option, that's bearish. You're thinking the price of XYZ Corporation is going to go down. That's stock. When you sell a put, that's bullish. You're saying, I think it's going to go up. So, buying a call and selling a put are bullish. Selling a call and buying a put is bearish. Let me say that again, make sure I said it right. Buying a call and selling a put are both bullish. Selling a call and buying a put are both bearish. Okay. So, you have a strike price and a strike date. In our example, XYZ Corporation, XYZ Company was $100 a share. The reason I'm going through this is because despite everything I said about just making a wager, there's two times when you could consider options trading. It's a perfectly legitimate thing to do, and I'm going to emphasize this heavily, to just forget options trading altogether. But there's two times when you may want to consider buying an option, and I'll cover when those two times are in just a moment. Okay, so in our example, you have to have a strike date and a strike price. The price of XYZ is $100. Call options can be out of the money or in the money. If the strike price is above the price of the underlying security, $100, then that's in a call option, that's out of the money. For example, if the strike price is $110, well, that's above $100. Why would somebody buy XYZ, the stock, at $110 when you could buy it at $100? You wouldn't. Okay, so that's called out of the money. If the strike price is $90, that's below the price of XYZ, that's called in the money. The higher the price, the higher the strike price, the higher the strike price of the call option, the lower the cost. Options are traded in lots, by the way. When you buy an option, it's 100 shares. So one option is 100 shares, generally. Okay, so puts, it's just the opposite. If the strike price is at $90, that's called in the money. No, when the strike price is $90, that's out of the money. I was thinking about calls. On put options, when the strike price is below $100 in our example, that's called out of the money. If it's above $100, like 110, the strike price, that's called in the money. Why would you sell at 100? Why would somebody sell at $100 when they could sell it at 110? Again, the answer is they wouldn't. They would just sell it at $110. Okay, so here's how the option works. It has a strike date. It could be a month out. It could be a year out. But on a call option, for example, somebody sold the call at, let's say, $110. If that price, that's out of the money, if the price does not, of the underlying security, does not go up to and above $110 by the strike date, then the option just expires. The person who sold the option keeps the cash. When you sell an option, you get your credited cash in your account. When you buy an option, then that's a cash debit in your account. You have to buy it. Okay, so if the price of XYZ doesn't go up to and above $110 with a strike price of $110, if that doesn't happen by the strike date, the person who sold the call just keeps the money, keeps whatever that amount of cash in their account, and the option expires. Okay, and then, the same thing with the put option. Okay, so that's just kind of the basics of options trading. Just understand that you're making a wager. That's all it is. Here are the two times, despite that, here are the two times when you could consider, in my opinion, the only two times when you could consider buying an option, despite the fact that you're making a wager. And again, I'm emphasizing heavily, if you just want to forget options trading, fine. If you just don't want to bother with it at all, then fine. Okay, so the two times when you could consider buying an option. Buying a call, what's called a deep in the money call. In our example, so a deep in the money call, in our example, XYZ was $100. A deep in the money call would be a strike price of, for example, $50. Okay, so you buy a deep in the money call. Why would you buy a deep in the money call? Well, there's a couple of reasons, but one main reason is when the strike price and the price of the underlying security are very close together, the difference between the bid and the ask, think of it like the brokers of VIG, the difference between the bid and the ask can be big enough to drive a truck through it. I've seen it a million times. I looked at these options many times. When you buy a deep in the money call, the difference between the bid and the ask is much more reasonable. When should you buy a deep in the money call option? This is very important to understand. Options magnify gains, they also magnify losses. Example, what would you expect the price to be? In our example, $100 per share was the price of XYZ. What would you expect to be the price of the call option at $50 a share? Well, let's call it $50. The difference between 150 is $50, right? It's probably going to be a little bit more than that in most cases, because stocks generally tend to go up over time, but obviously not always. Let's call it $50. That's the price of the option. If the price of XYZ goes from $100 to, let's say, 110, people who own the stock, well, they made 10%, right? They didn't realize the gain yet unless they sell it, but on paper at least they made 10%. The person who owned the deep in the money call at $50, they gained $10 per share from 100 to 110 on the $50 investment. 10 divided by 50 is 20%. You magnified the gain. The opposite happens, however, when the price goes down, when the price of XYZ goes down. If it goes from $100 to $90, so the value of your option was $50, now it's only $40. So you lost $10 on a $50 investment, you lost 20%, not 10. Options magnify gains, they magnify losses. Why? Because you're making wagers. Okay, so the one time when you could consider buying a call option is a deep in the money call, but you need to have a really high level of certainty that the price of XYZ is going up. The other time when you can consider buying an option, the only other time, in my opinion, is when you're buying a put option to buy protection. And here's how it works. In our example, the price of XYZ was $100, and maybe you've owned it for a long time. Maybe you own that stock for a while. You want to continue on it. You see it going up over the long term, but maybe you're a little skeptical of what could happen to it over the short term. So that's maybe you want to consider at that point, you could consider buying protection. For example, if you bought the put option at $90, well, the near loss, you have to buy it. That means cash coming out of your account, but you're buying protection. No such thing as free in investing. There's always a trade-off. You want to buy protection, it's going to cost you something. Okay, so buy protection. Let's say you bought the put option at $90. Well, for whatever length of time, at least to the strike date, you're protected. You've capped your losses at $10 per share from 100 to 90. For example, the price goes, let's say the price does go down. Let's say it goes down to 80. Keeping in mind you bought an out of the money option, okay, but it becomes an in the money option if the price of XYZ went from $100 to $80 in our example. So why would you've bought the right to sell at $90. Why would you sell at $80 if you could sell at $90? You wouldn't. You would sell at $90. Potentially, in that example, you would just sell your shares at $90 if you wanted to. You could turn right around and buy them back again at $80. Okay, so you've bought protection. You've capped your losses. There's a reason to buy a put option. Here's the problem. You can't just go around buying protection on everything you own. If you do, you'll kill your returns. Over the long haul, you'll kill your returns. But that's an example of when you could consider buying a put option if you wanted to buy protection. Okay? I would use it very sparingly if you do it. One more time, I'm emphasizing heavily, if you want to just forget options altogether, fine, don't worry about it. Here's the main thing I wanted you to get out of this lesson, okay? And what's true in currency trading and commodities trading and options trading, all three of those things. Oh, by the way, back in the day when I was studying options trading, I know all kinds of different patterns. They have people do bullish call spreads, bearish call spreads. That means you got to have, there's two options, one you buy and one you sell. You can have bullish put spreads, you can have bearish put spreads, diagonal patterns, straddle patterns, strangle patterns, butterfly patterns. Some of these things can involve more than two options. But here's, each of those options in that pattern is making a wager. Well, then the sum of those options is making a wager. Okay, you're just making wagers. So here's the main thing I wanted you to get out of this lesson. And what's true in currency trading, commodities trading, options trading, you're making wagers. That's all they are. And the broker couldn't care less whether it goes up or down, or who wins, who loses. Just like the sports book, they're making money. Okay, or making revenue at least. Okay, so that's the main thing I wanted you to get out of this. When you put it in these terms, what would you rather do? You want to make wagers, or do you want to be an owner of capital? an owner of the means of production. When you put it in those terms, then the answer becomes very clear. We'll just go by the stock then. Focus on the fundamentals, find good companies and just own them. Investing is difficult enough without overcomplicating everything. There's plenty to learn about the stock market and plenty of things we haven't covered yet in lessons 1 through 9. This is lesson 10. Lots of things to cover yet, but basically it comes down to you want to find good companies and just own them. Be an owner of capital. Own something, not just making wagers. Okay? And here's a really important thing to understand about that. It's just like in sports wagering. If you're just this good at it, so this is how good the population is as a whole, if you're that good at it, you're going to lose money over the long haul. Why? Because the bookie has a VIG. In sports wagering, they call it a VIG. In commodities and currency trading and options trading, they call it the difference between the bid and the ask, okay? But if this is how good the population as a whole, this is how good they are at it, if you're just that good, in the long run you lose money because of the VIG. So you got to be that much better than average just to break even. And then everything above that is revenue for you, if you can do it. But here's the other catch. So you got to be this much above average just to break even. But then that still doesn't even factor in opportunity cost. That money that you put on the yen versus the euro, for example, they're not paying you a dividend for the length of time that you're in that position because you don't own anything. You're not an owner of capital. That's money that you could have just had in the stock market or even a bond. This is a heavy focus. This whole series is a heavy focus on the stock market because that's where the most wealth is created over time. But even though there's a time and a place for bonds in a portfolio, covered that in a previous lesson. But my point is there's always an opportunity cost. If you're in that position of yen versus the euro, they're not paying you dividend to be in that position for the time that you're in it. You could have just been an owner of capital, put it in the stock market, or a bond, or for that matter, if it's cash that you may need or you may want to take out again, let's say 6 months down the road, you could have just had it. For that matter, you could have just had it in a savings account, earning about 5% right now. This is August 21st, 2024. You could have just had that money in a savings account earning about 5%, right? We don't think we're going to be able to get those interest rates indefinitely because eventually interest rates will come down. In fact, we're expecting a rate cut next month in September. We'll see if it happens. Could be a quarter of a point, could be half a point. We're not sure yet. But in any event, right now you could have just had that money in a savings account, if nothing else, earning 5%. So if you're going to get involved in these wagers, you got to be, if you're at that level, you're going to lose money. That level, you're going to break even, but then we still haven't even factored in the opportunity cost. Okay? So, the opportunity cost being you could have just been in the stock market or a bond, or for that matter, had it in a savings account earning an interest rate. Or, whatever. So, very important to understand that. Options trading, commodities trading, currency trading, you're making wagers. That's all they are. So when you put it in those terms, what would you rather do? You want to make wagers or you want to invest? You want to be an owner of capital. When you put it in those terms, the answer becomes very clear to me, and I hope it's very clear to you. Focus on the fundamentals and just stay in the stock market. Okay? So that was lesson 10, and you can see why I put all of those three things together: options, currencies, and currency trading, commodities trading, because they're all making wagers. That's what they all have in common. All right, so that's lesson 10. Don't forget to hit the subscribe button when lesson 11 comes out this coming Saturday. I'll put a link to it in the description below, and in addition, I'll put a link in description 10 to the first lesson, just like every lesson has, and there's a link in every lesson to the next one, so they're all easy to find. You are going to be an investing knowledge guru by the time you finish all this, and we still have a lot more to cover. Okay, so that was lesson 10. I hope you got something out of it. This is August 21st, 2024, Wednesday. Hope you're having a great week so far. Hope life is treating you well, and we'll see you Saturday.